Welcome to Brainstorm. I'm James Roth, Chief Revenue Officer of Membrane Labs. I'm here with our fearless CEO, Carson Cook. And today we're joined by Craig Birchall, Head of Credit of the Americas for FalconX. Welcome to the show, Craig.
Thank you, guys. Thank you for having me.
Nice little homecoming for you.
I know.
Welcome back to the mothership. Craig, let's start from the beginning. I feel like we all know each other. We've all worked together. Spoiler alert. Just quickly, if you could give us a brief background, I think that'd be helpful for the viewer.
So the brief background, I was in lending at JP Morgan for a while, had my quarter life crisis where I decided to, wanted to get out of the bank and join Galaxy as they were standing up their lending business, working for the head of lending there. And then I left to join you great folks over at Membrane, building software, lending software, collateral software, settlement software for, the prime brokers in the industry, having seen firsthand at Galaxy, like what was really needed for those types of organizations. And now I'm at FalconX, where I lead lending. FalconX is the largest crypto prime broker in the industry. It's the only CFTC regulated swap dealer. And we have a spot trading business. We have a derivatives business, which is consistently number one on Paradigm. We have a FX business. We have a custody business. Again, we have an on-chain partnerships business. And then we also have, of course, a robust credit business.
We're all curious to know, okay, what's it been like? So you joined FalconX, you're back in a credit trading seat. I think in particular, just having left Galaxy 3 years ago, or I'm trying to remember how much time's passed.
Three or four, yeah.
Yeah, so 3 years have passed. You're in a credit seat again.
Yeah.
How has it been?
The market has changed. And there also was a bit of just shaking the cobwebs off and getting used to thinking about things in the same way that you used to think about them. Doing a lot of math in your head again, in a split second, that kind of stuff. You got to get back, get back to doing and also seeing okay, what's changed in the markets, what relationships are different, who's around, who's not around.
I'm sure there's been a ton of turnover. Since
who's at a fund and it's something different now, and you didn't realize, oh, it's that guy. Oh yeah. So that's
But is there a different set of behaviors or clients that have emerged when you sat down and you're like, oh my God, what is this? I haven't seen this before. Or
client profiles isn't really that different, to be honest, because we had traditional institutions that would trade, when we were at Galaxy and so on and so forth. Maybe you have a few more of those that are in there. I mean, you certainly have the ETFs and whatnot. So that's been interesting.
Well, now you have these treasury companies that are popping
up. Yeah, and the treasury companies now. You also have, but you still have the foundations, the high net worth, the family offices, the crypto natives, the exchanges. What's been interesting has been, when we were at Galaxy, we were just starting to explore being on chain. And then, now coming back in where, the likes of a FalconX or the likes of a Galaxy, we're able to interact more and more on chain in different ways. That's been something new and getting used to. And so, we've brought on a new head of on-chain partnerships, Brandon Sigri, and we have a head of DeFi strategy, Mike Feldman, and those guys get really in the weeds, and we see new projects, existing projects. And so being able to interact there has been something interesting to get used to.
And that's more driving cheaper cost of funding for FalconX. That's more driving greater yields on balances that end up on DeFi, or is it a little bit of both?
Yeah, it's a little bit of both. And FalconX as a whole takes a holistic approach to it. There's opportunities to get involved in early incentive programs and TBL deals and, support our broader custody and infrastructure business and staking, as well as eventually those folks will have a treasury and they'll need treasury management and they may go do hedging down the road. And, right off the bat from the credit standpoint, it'll be, trying to source capital or find yield opportunities. It's kind of like a whole team effort in a sense. And then I think the other big thing that's changed since, being at Galaxy is just the proliferation of secured lending, in the sense of a lot of us took collateral, but a lot of folks were one-to-one under collateralized or just straight unsecured. And that was like primarily where we used to source most of our well, not just us, like that was like where everybody was like sourcing their capital at the time. And so now having to adjust, because it's not just like adjusting, okay, like who are you dealing with, or it adjusts the entire way that you think about like pricing loans and also how you think about risk. Because now you actually have exposure to the people that you're borrowing from. You need to figure out, okay, like I need to post collateral. Where's that collateral coming from? And how am I going to think about pricing now a loan? And so like it creates this interesting, because there's now also the proliferation of folks that want secured borrow and in a non-rehypothecation like structure, which is fine. Like anyone can price like rehypothecatable or non-rehypothecatable, but it makes all of this like there's a whole, I guess, extra portion of the math and the calculus that was just less common back then that goes into like pricing these deals. And so that's also been one of the bigger shifts.
So Craig, you mentioned that a difference in the 2025 market structure is an increased prevalence of on-chain yield. Maybe you can talk a little about kind of what the push-pull is between institutional rates and DeFi rates. Is DeFi generally driving institutional rates and kind of setting the market, or is it the other way around? Is institutional and more kind of a desk-to-desk rates driving DeFi rates at the moment?
It's an interesting dynamic, actually, because you know, a lot of what you do when like you're pricing out credit is like you have to come up with what is your cost of funds. And in the bank, they just give you a cost of funds number that like the central treasury is looking at. And usually it's something close to like SOFR. And so pricing on a floating rate is pretty easy. Whereas in crypto, you know, nobody's really funding on SOFR, at least like most of like the crypto native folks. And so you have to look at, okay, what is your internal cost of funding? And that can look in a variety of different ways. Also asset by asset. It's not just cash lending that you might be doing. What's interesting is the institutional players come into the space, like the more traditional finance folks, they'll usually price off something like a SOFR, like we would have seen, you know, day in and day out at JP Morgan. But then in crypto, what is actually driving sort of these like risk-free rates or like the alternative rates you would price off of? And it tends to be, you know, you have the basis trades. Bitcoin basis is kind of like a good proxy for where rates are going, only because it's not just like, hey, these are sort of risk-free trades that you could put on, but it's also an indicator of just like bullishness in the market. And when there's bullishness in the market, there's more of a demand for leverage. And so rates are going to go higher either way. So not that you're necessarily marking things off basis, but it's a good general indicator. And DeFi still has like this piece where there's, you know, you'll see like you can get 5% depositing into an Aave pool. How is that possible when there's folks that are borrowing out there or lending, or like you quote CeFi and it's at 9.5 or 10 or something like that right now? Why is that happening? And that's because not everyone can access those pools. And not at all of your, you know, someone depositing into a DeFi pool can access those institutional players in size and scope, in terms and structure. And so it kind of creates this interesting like dynamic, but it's not a pure arbitrage either, because there's big trade-offs too with dealing on chain. And so like, you know, the reality is like there's different pools of capital that are all funding themselves in different ways. And so you'll see some wildly different terms and rates depending on who you're talking to.
So restrictions due to size and I guess participant eligibility or willingness to go into these things keeps everything separate. And it means that DeFi doesn't necessarily drive things. It's more an opportunity for those that can join it.
Yeah. Now what DeFi does drive though is like if you have a client that is crypto, you know, more crypto native and they see yield opportunity somewhere, they may have demand now suddenly to borrow something at a certain percent if you could figure out what it is that they're doing. It's the same thing with like perp funding rates and trades that way. And obviously all these things are kind of interconnected. Sometimes perp fundings will blow up because of something that's happening on DeFi or whatever it might be. And so like, or token unlocks or whatever. And so all those things are sort of intertwined, but it's not every, you know, you kind of know the clients that are going to be trading on something like that versus the ones that don't based on their strategy.
Yeah, I think it's interesting because therein lies the opportunity for a specialty lender who can see across that and be a central nexus for that.
Today's episode of Brainstorm is brought to you by Membrane, powering institutional lending with our risk engine for loan servicing, collateral, and custody. Our infrastructure delivers real-time risk clarity, unifying workflows across the loan lifecycle. Crypto is evolving. Book a demo today.
So let's talk a little bit about who the players are and what the competition looks like in lending. So I think last time you were in a seat at a lending desk was 2022. If you kind of compare contrast 2025 today versus 22, are there more participants? Is the market more segmented? Are new people popping up at the moment? What does that dynamic look like?
If I had to take a gut sense, I would say that there's fewer folks in the industry than there were before. And maybe it's not that there's fewer, there's probably more, but there's fewer that you would transact with regularly in size, I guess is maybe the way to like put it, where like, you used to have the BlockFis, the Genesises, the Celsiuses, the Coinbases, the Anchorages, and, so on and so forth. And you sort of had your laundry list of names that you would deal with like kind of in the inner dealer market. And there's less of that. There still is, and there's still a decent amount of names, and there's folks that are getting like back into the business. But you don't have much retail aggregation anymore, which I think is part of that. And I think folks are trying to figure out the right way to do that in a risk managed way that's maybe different than last time. That
let's hope it's different than last time.
Let's hope it's different than last time. Yeah. And honestly, a lot of that is just driven when you have a bunch of unsecured lending, then everyone's getting levered and you can just it's a lot easier to go around. Whereas like when you're doing everything secured, capital's getting sucked in different directions. One could argue that it's like getting captive or something, like when it's in a rehypothecation or non-rehypothecation, like account control agreement. Well, now you have 150% of it is actually now captive versus the one that was gone and deployed. So that's actually we have interesting structures that we can talk about later, like that try to get around that and give people like true leverage. But it's so I guess that's part of it. I mean, like you do have the
So what we're not seeing though, not to cut you off,
but
what we're not seeing
is
an influx of new, cheaper sources of capital. So meaning there's no kind of every leverage is always constrained, particularly for the lenders in the space. Everyone's trying to increase balance sheet. Everyone's trying to expand. So, have you seen new entrants that are providing wholesale financing to the lenders of the space, or has that kind of remained people aren't touching this?
I wouldn't say that there isn't like more. Like there is. But there's capital that's being routed through DeFi, certainly. That is coming that way, but is like in institutional size. So that's that there is new capital there. There's also, there's new entrants, especially like internationally, that have come in that have sort of replaced some of the old entrants more so than I'd say like just like it's not like, it was one before, now it's two. It's like it was one that went down to like 0.25 and now you added another one. So now you're about like 1.25 versus like one. So it's not like, a drastic increase, but the market effectively like collapsed before. So there are new players. There's also a lot of folks trying to stand up lending businesses in one way or another, or especially there's a proliferation right now that we're seeing of, kind of asset managers that are trying to offer yield generation strategies for people. And those yield generation strategies take a lot of different forms where, whether it's folks that are doing derivative strategies or folks that are just lending or also folks that are going and looking to borrow cash. So they're effectively like borrowers. They would be like clients of ours, but they're thinking of it in a way where it's actually, they're thinking, okay, I've deployed 200% in XYZ token for this USDC loan. Like, what's the return actually on that capital? They're thinking of that, this is a return on that capital, when really that's the collateral for our loan. And they'll go then take the stables, which they believe will have a higher yield generation opportunity. And then they'll just convert it all back and denominate it back in the initial. So like you can always come back and be like, okay, well, what is like your in-kind yield? When really, at the end of the day, it's kind of posted as collateral and, you went and just took down cash and traded against it. Yeah. So that's something that we've definitely been seeing a lot of too.
Are you seeing innovation? I think we've kind of all seen what's going on in terms of DeFi lending and what's going on chain, but in terms of off chain that maybe people aren't seeing under the hood that institutions are playing in, are there innovations around products or different credit structures that you're seeing that have evolved over time?
Trading related financing in the sense, or like trade based financing. So whether it's a delayed settlement or it's facilitating a short sale or it's, helping to put on a leverage position. Like before it was, back in 2021 and 2022, that was a pretty manual process for a lot of folks. And now you've seen a lot of people like really clean up how that works. And so like, it can almost in effect be automated for the most part. As well as, we've done interesting work on allowing folks to do like a one-click borrow on a physical token when you actually want the physical and you're not looking to go short sale for that. So like that's starting to evolve. You've seen folks that have gotten a lot better at like portfolio margining too. The exchanges have always been decent at this, but you're starting to see it a bit more. Like we do it here at FalconX. I was actually pretty impressed when I came in with the tech stack.
Just switching gears a little bit, talking about market structure as it pertains to credit. Are there still missing pieces? Yes, right? It's not as perfect as it could be, and there's still edge being gained by folks that have a lot of customer relationships. But are there any pieces of market infrastructure that you'd like to see to help bring more participants in, more liquidity, more deals being able to get executed? Or are you kind of liking where things are? And where they've evolved to now that you're in this new seat?
There's still a lot of folks with, funds on exchange, and that's started to evolve with like a lot of folks having some kind of off exchange solution, but they're not really interconnected in any like prominent way. And if they are, it's usually like centralized again with like one individual custodian. That's an innovation that still is yet to come.
I can tell you at least from, and this is more of maybe a leading question, but what we hear at Membrane is more around not being able to get transparency, not being able to see where our rates are, because there's a lot of walled gardens. There's a lot of liquidity being offered in vacuums where terms are obviously, there's a lot of asymmetry in information, particularly on the borrower side. You obviously sit in the side where that's, a feature, not a bug. And so, I'm more curious on that front. Not much has changed there, right? There's no real area in which there's a lot of transparency being offered around here's where lending rates are, here's where people are in the space.
In order to know where rates are, you have to look at like 5 to 10 different things. You have to have a bunch of different tabs open. You could try to write something in Python or whatever that tries to pull it all in. I tried to get you guys to build it in Membrane. But like, it's like, that still exists. You see all the time, like someone will come in and be like, well, why that rate? I see funding over here is like this. It's like, yeah, but we don't even look at that because we look at this, and this. So I think transparency in a sense of just like overall, like what is moving sort of the rate markets generally it would be a good innovation. But I don't want to be the one out there that's arguing for a more efficient market and a more efficient kind of race to the bottom.
We see you, Craig.
But I also like not even like non-flippantly, it's hard because we're not talking about the same instrument either. Like
no, but we could be. And we could be standardizing around.
You're right.
Instrument.
Yeah. So if it's the exact same instrument.
Because that's ultimately where we see it going. Yeah. But you're right.
Yeah, like if you have a standardized repo market, then at least you will have transparency into where that market is trading. Now, I think that that's not going to be all the volumes that happen because things still have to be bespoke, but that will give you actually like a general like running idea and like a benchmark of where rates are. But there is still like a dynamic because of whether it's the risk profile of the borrower or what they're borrowing or whatever may be like the terms of the deal. Like you could both come in for the same size loan of cash at the same term, and you're both going to see wildly different things. Not just because of like me, like, going and trying to price something out and take advantage of one of you versus the other, but actually because like your risk profiles might be different and your tolerances and how much you do on the trading side with us or what have you. Like all of that kind of like goes into the overall equation. But yeah, there's definitely a better way, and I know we thought about this when I was at Membrane. There's a better way to tackle the connectivity among lenders and borrowers and the interdealer market, I think, in a way that doesn't turn off all the lenders or make them feel like they don't have the tools that they need to properly risk manage the deals that they're executing. There's definitely a middle ground there that I think still has to occur.
So market has been on an absolute tear over the last however many months. I can't even remember. It just feels like every day the market goes up. And you were talking about bullish indicators before. So any bold predictions going into the year? Is this the tail end of the rally? Are we going higher? And what does it mean for credit markets?
I think that we have a little bit of juice left in this rally for sure. For at least the next 3 to 6 months.
Don't sound too excited.
And
that sounds great.
Well, like it's like, because here's the problem. When you're running a credit desk, you think about it differently than when you're running just like
trading desk.
Yeah, like a trading desk. Like a bullish outlook is a great thing for us. It means more people that are going to be borrowing. It also means higher borrowing costs for us. So you think about going and you think about how much fixed exposure do you want to be? How much balance sheet do we want to make sure that we have ready going into a bull market? And we certainly, we feel really good about where the market is going right now. Do not get me wrong. All indicators are pointing toward continued strong growth, especially going like into the end of the year. And again, like
strong growth of what? Of crypto, or strong U.S. economy?
Yeah, no, strong growth in the crypto markets.
Okay.
And I think that
I mean,
the US,
certainly
the US
influx
economy,
of natural buyers of crypto has just taken by
there
storm.
is. I think like there's a lot of tailwinds that come in, obviously through the regulation, through some of these treasury plays, the access to the public markets, the ability of the ETFs to kind of be a little bit more flexible. Like where now liquid staking is something that's okay in the ETFs now. That's huge. And so and we know a lot of the folks that are behind like the liquid staking groups, and there's some like really cool, really buttoned up projects out there that are designed for like the institutional side of that.
So a large narrative that seems to be developing mid-2025 are the publicly traded treasury companies that are acquiring Bitcoin, acquiring ETH, acquiring Solana. Parts of that seem like a bubble to me. I'm curious if you have thoughts on that. Is it a bubble or not? Maybe question one, and then question two, maybe more relevant for you. How, if at all, does that play into the credit markets? And do you see those new pools of capital that might be captive for quite some time as participating in the credit marketplace? Will that supply be lent out in any way? What does that look like?
Yeah, it's really interesting. And it's like really top of mind for us and probably most of the other desks that are out there as well. The thoughts on whether it's a bubble or not, or a fad, I think crypto has cycles with these types of things. But all of the cycles still end up having, having some, maybe not everybody makes, but there's usually still some residual folks that still are around, like whatever the cycle may be. And so I think that some of these treasury companies are kind of like the blue chips that you can see at the market itself is valuing at higher valuations for what they can do and how they'll be able to generate returns as they continue to acquire more and more assets. It's interesting. Some people put it akin to the grayscale trade, but it's not really. It's different in the sense of there really was no out unless Grayscale was able to transition into an ETF. And so whereas with these treasury companies, it's different. And they have a lot more tools in their toolkit where, whether it be share buybacks or, all the different interesting instruments like MicroStrategy has gone and put together with the converts and what have you. So I think it's really cool actually what they're doing and how all of them kind of have different mandates in a sense of what they can and can't do. When it comes to the credit markets, there's both. It's kind of two-sided. Yes, we are on the lookout for how much supply is really going to come in. Are we suddenly going to see a ton of ETH supply out there in the credit markets as a result of these treasury companies in their search for yield? We're highly aware of that. And then also there's credit deployment for these treasury companies. These folks will put on massive, massive trades. Sometimes groups will want to settle T+2. T+3, T+4, and we'll see how more and more creative they can get. And so that's big too, in a sense. And then you also have investors that we've seen that want to let's say it's now this takes a lot between SPACs and de-SPACs and the pipes and the commitments and the pre-funding commitments versus not. And so it all sort of depends on the individual structure, but there's in the same way that there's a way oftentimes to creatively lend against locked tokens bought through a token warrant or what have you. There's also ways that you could probably do lending against actually the investments that are being made into these treasury companies. And so that's been something that we've been seeing too. So it's had an effect, I guess, in a multi-pronged approach. And, we'll kind of see where the trend goes, whether it stays as hot or cools off.
Risk in crypto isn't just price volatility. Institutions face liquidity traps, shifting margin exposures, and funding shocks, all of which fluctuate in real time. Even with strong internal tools, risk teams are often left with siloed systems, inconsistent assumptions, and fragmented views internally. Membrane's risk engine, powered by BitPulse, helps institutions model, manage, and anticipate risk across the full trade lifecycle, from pre-trade to post-trade. All accessed through a simple interface or direct API. Stress test loan portfolios based on historical look-back periods and various asset price models. Quantify margin call risk ahead of market moves. Standardize and automate risk calculations across counterparties and assets with customizable templates. Estimate liquidation and margin call probabilities before initiating trades. Designed to fit into existing workflows, Membrane's risk engine supports decisions with institutional-grade risk models and customizable assumptions. From onboarding to daily risk monitoring, we simplify complex risk infrastructure to make it easy to adopt and scale. Membrane's risk engine, where quantitative rigor meets real-world decisions. Crypto is evolving. Book a demo today.
Okay, so that's obviously massive tailwinds for the industry. Things are going well. Where do you see hidden risks lurking? Where do you see kind of risks, and what keeps you up at night, I guess? What worries you about the marketplace as it stands?
What keeps any risk manager up at night is their exposure. But the exposure takes like different forms. Like, we feel very good about our ability to manage risk when we are the lender.
So then talking more broadly.
But like more broadly, we feel really good about our exposure when we are the lender.
Mm-hmm.
We feel good about our exposure and our ability to liquidate collateral or foreclose.
Mm-hmm.
We feel good about how we can manage our duration and our book overall to kind of keep the whole machine running. What keeps you up at night, though, is, well, okay, so what's out of your control?
Mm-hmm.
So what's out of your control is, okay, obviously, like where is all the money parked, the custody risks that you're going to have. Now, a lot of that has gotten better over time, but you don't know for sure. You also have, now that everyone lends to folks secured, you run into a situation where, okay, even if it's parked in tri-party, first of all, there were situations in the previous cycle where it was parked in tri-party, and the bankruptcy and the entity, the trust entity that was there, actually went bankrupt anyway, and people lost money. So that doesn't necessarily guarantee at all that the funds are going to be there. Likewise, with what is the definition of qualified custody? You're going to get a bunch of different answers from people here in the US, and you're going to get a bunch of different answers from people internationally about what qualifies, like what qualifies for qualified custody under MICA or under Singapore rules or what have you. It's different. There's also legal risks that are associated. Like, you have to like really, really watch what goes into your legal agreements, which is why I say like every lender is half lawyer, and you'll catch things that will be like provisions where either on someone else's form or that someone tries to get away with on a red line of your form that, like, 99% of the time it never comes up. So people don't really care. Like, who cares? Why do you spend all your time on the legal agreements? It's like, yeah, it doesn't come up until it does. And I've been in plenty of positions, and other lenders that are out there, they're like the crypto veterans, they've been in positions too where you've seen that those provisions start getting enacted real quick when it really, like, when push comes to shove. And I'm worried that folks that are in the lending market right now, or really that are offering yield services generally, what are they actually doing is a big piece. Some folks are more upfront with it, where, like, I'll take a look at someone's like, hey, do you want it'll be like, hey, this person's getting a 2% loan against their Bitcoin for 2 years. And I'm like, okay, so there's obviously some derivative component that's associated with this. Mm-hmm. And you have to make sure that when you're talking to your clients that it's apples to apples. And then you'll look at the terms, and some folks will be upfront and others won't be. And then others we've seen, I know that there is a derivative component on the other side, but it's not necessarily like fully passed through into the agreement, I guess, so to speak. Or like you could tell something's just not being duration matched, just straight up. Like, we'll see like a 18-month loan that someone wants to do at some ridiculous rate, and we see the rate that's being shown. I can probably back into how that other dealer is getting to that rate. It's not being duration matched. So all that kind of behavior worries me because like you always have to be worried about, it's like same thing in like the financial crisis. Like it doesn't matter if you like manage your book, like, you know, if your institution is really good and you can manage the risk, you know, like we did at Galaxy, like FalconX did through the last crisis. Yeah, but either way, the entire industry collapses. And so you still have to deal with, you know, years of like market collapse and market infrastructure collapse. And so like, you know, we feel really good about our book currently and our counterparties and our risk management, but that doesn't change other people blowing themselves up or blowing it up for their clients. It's going to tank the market anyway. And like there's an opaqueness that's there that I could just sense and could see. And in like side conversations have understood as folks talk that is dangerous. And the last thing I will say on that too is I've seen some folks that are out there going to make the same mistakes that were made the last cycle.
Oof. Sounds eerie.
And
don't name and shame, Craig. That's not what this podcast is for.
I won't
That's
name and shame. And you could say it as just a general statement, but like anytime there's occasionally like we'll run into something and I'm like, and we'll just be like, did nobody learn from the last time? And so I see a little bit of that, a lot less of what was going on last time around, but sometimes that creeps in and that kind of thing keeps you up at night too, I think.
So Craig, in 2025, new administration in the U.S., crypto activity here seemed to be picking up. Talk a little bit about globally. I know if you rewind to 2024, there was a lot happening in Europe. My sense is that there's maybe a little less activity there, and maybe Asia and Middle East are picking up, but maybe you can talk about different jurisdictions, different geographical regions, and kind of what's going on there, particularly in the credit space.
Yeah. It's also interesting too, because like crypto is a global market and like you might be talking to a firm that's in Europe, but like the guy you're on the phone with, he's in Berlin, but the other guy's in New York on their team. And so like everyone's kind of become more global, I think, in this industry. Like we were at Membrane, like we were at Galaxy and are at FalconX. I think in Europe, you do see, probably I would say a steady amount of activity relative to recent years, not like dramatically decreased or dramatically increased one way or another. There tend to be a decent amount of high net worths in Europe, and then you'll run into there are funds out there. We've done transactions with some miners in the broader European region. And so I would say that I see it as kind of just on a steady path with the growth that they've kind of had. And Micah, I think, has helped. Asia is in an interesting place because, a lot of Asia is dominated, or at least like among the sell side desks, like a lot of the transactions that, like a lot of the folks you transact with were these trading shops. And so they will come in and have a, extreme, hungry appetite for taking on leverage when it makes sense for them. And then they will put it down. Take it down otherwise. And so, we have a lot of good relationships with trading firms in Asia. But we've also seen that there's a mining community in Asia that has started to come out. And then there's also the, like we mentioned, the card issuers, the payment processors, some of the banks
and that's
out
in Asia.
In Asia. That are able to like that is something that has started to come in and just is an interesting kind of set of folks to trade with that aren't just like the major VCs or the major like trading shops. And obviously you always have the high net worths, the ethereal high net worths that everyone knows everywhere. Like you do have that, the family offices, but but definitely among the mining community there and among some of these other just like general corporates, there's a good amount of activity and they're pushing through.
And what's behavior like? I mean, in Asia, are these guys looking for different things or more of the same? Just general overarching leverage? Do they want term? Is it bigger size? I mean, or is it just more of the same that we're seeing here?
Yeah, I think it depends on the client profile. So a lot of folks can just borrow on exchange. So that's one piece. But there's usually like pretty strict limits on how much they can borrow on exchange. And a lot of times it's floating. Which folks don't
love.
Yeah, they don't love. And so being able to get term, being able to get fixed rates, being able to get at a greater size is to folks' benefit. And sometimes you'll have these exchanges will make these deals with certain strategic partners for like 0% interest rate loans. So that's obviously a hard thing to compete with, but usually the money has to stay captive on the exchange and they're going to be making it back into trading fees. So, where we've gone to differentiate ourselves is if we will cross margin across a variety of exchange accounts for you, you can now get the benefit across your entire portfolio, as well as like we're bringing hyper liquid into that structure too now. So if we bring in, if you have Binance, OKX, Bybit, hyper liquid, and we're able to cross margin all your positions and give you leverage there, that's sort of the differentiator that folks will see is worth it, versus, maybe even a 0% interest rate, but it's just on one individual venue and there's some degree of a cap.
And that's actually exciting from a FalconX perspective because the technology lift to be able to combine those elements, the on-chain, the off-chain, it's quite impressive.
Yeah. And you have to be a firm that's like has the legal, the compliance, the regulatory like infrastructure that's able to support all of that. And it has not been a quick process, I think, for anybody that started. And being able to have that flexibility, I think, is actually a really big differentiator for like a FalconX of the world relative to like
we'll call it institutional agility that you have.
Institutional agility. That's the word I was looking for.
That's a new term. So Craig, before we sign off here, any bold predictions looking forward to the next 12 to 18 months in the crypto space?
Bold predictions. I would say, I think that there's been a lot of consolidation in the industry, and I think probably in the next 12 to 18 months, you are going to see at least one of the traditional finance institutions make a major acquisition of one of the larger kind of more crypto native up to this point institutions. Now, whether that's a custodian or a sell side desk, but like I think like you will see that, and you will see the banks, take a leap forward there.
Only one or multiple?
Well,
I think it kind of depends on where regulation falls out, right? To define kind of how this all works. But assuming we have that in place, then those types of moves
it does.
can happen.
And some are more aggressive than others. And like some FCMs or prime brokers are able to kind of be more on the cutting edge. Like you see it when like lending against the Bitcoin ETFs. There's some that'll do an 80% LTV. And then, you'll have others that do 25 and make a big announcement and, have a cap of whatever the cap is on the exposure. And so like, I think like some, but like, honestly, in fairness, even to JP Morgan, it's like they will tell you that they're not going to be the first movers on anything. They're going to wait and see. They're going to have someone else go be the first mover, and they will go and see if it plays out, see how well it does, see if it stands up regulatorily, and then they'll move as an institution. And so, but there are others out there that are much more on the cutting edge. And so I think that that there will be an acquisition of one of these parts of the large institutional trading infrastructure, again, whether it's custodians or whether it's a sell side desk or what have you, from one of these banks.
Craig, thanks so much for joining us again today. It's awesome to have you back,
absolutely.
even if you have a different shirt on.
Oh, I got this shirt. I still have my membrane shirt. We could swap. We could switch seats. I'll host again if you guys want. But no, thank you so much for having me on. It's really great to get the band back together with you guys, and I hope that we can do it again.
We'll do it again.